Are we heading toward a recession after the Federal Reserve's latest signal? New economic data is raising fresh concerns about the direction of the U.S. economy. Growth is slowing, consumer confidence is shifting, and borrowing costs remain elevated. So the big question tonight is simple. Are we facing a temporary slowdown or something more serious? I'm Michael Reed, and this is the Real Update News. In our previous report, we broke down the Federal Reserve's signal that interest rate cuts may be approaching. But rate cuts don't happen in isolation. They often reflect deeper economic trends, and sometimes economic stress. A recession is generally defined as a sustained period of economic decline. It often includes shrinking GDP, rising unemployment, declining business investment, and weaker consumer spending. But recessions rarely begin with one dramatic event. They build gradually, through warning signs. Recent GDP reports show economic growth slowing compared to earlier quarters. While the economy is still expanding, the pace of growth has cooled. That slowdown alone does not confirm a recession, but it does raise caution flags. The job market remains relatively strong. However, hiring growth has moderated. Some industries are reporting layoffs, while job openings have declined from recent highs. If unemployment begins trending upward consistently, that could shift the outlook. Consumer spending makes up nearly 70% of the U.S. economy. Recent retail data shows Americans becoming more cautious with discretionary purchases. When households begin pulling back, growth can slow quickly. Credit card balances have reached elevated levels. Higher interest rates have made borrowing more expensive. As debt servicing costs rise, households may reduce spending, adding pressure to economic momentum. The housing market has cooled significantly from its peak. Mortgage rates remain elevated compared to recent years. Reduced housing activity often affects construction, lending, and consumer goods sectors. Corporate earnings reports show mixed results. Some companies remain stable, while others are guiding investors towards slower growth expectations. Forward-looking statements from major firms often signal broader economic direction. Despite concerns, there are signs of resilience. Unemployment remains historically low. Bank capital levels are stronger than in past financial crises, and household savings, while declining, remain above pre-pandemic norms. Economists remain divided. Some believe the U.S. economy may achieve a soft landing, slowing inflation without entering recession. Others argue that delayed effects of higher rates may still impact growth in the coming months. Upcoming employment data, inflation reports, and consumer confidence surveys will be critical. These indicators may determine whether the economy stabilizes or weakens further. For American families, preparation matters more than prediction. Financial experts recommend maintaining emergency savings, managing debt carefully, and focusing on long-term financial stability. Short-term volatility does not always signal long-term decline. Whether the economy slows further or stabilizes, the coming months will be critical. If you missed our full breakdown of the Federal Reserve's rate signal, watch that next. We'll continue tracking every major development. I'm Michael Reed, and this has been the Real Update News.